Thank you, and welcome everybody. Super excited to be hosting this panel, the Institutionalization of Crypto Markets. I'm James Ellery, responsible for global currencies and emerging markets at Goldman Sachs on the trading side, as well as being CEO of the Singapore office, and run sort of, I guess, our wonderful digital assets team reports to me in region. So I think a quick introduction to the panel. As already mentioned, Tim McCourt, Global Head of Equity and FX, including cryptocurrencies at CME Group. Darius Sitt, co-founder and CIO of QCP Capital. Kayvon Piristani, who is the Head of Institutional Business at Coinbase in APAC, and Alex Hopner, Chief Executive Officer at BitMEX. I think today we're looking at a sort of deep dive into institutional participation, infrastructure development, and really the latest market trends in crypto markets. Maybe I'll start and turn, maybe starting with Kayvon and work along the row. Just a quick introduction about yourself, your background, and your business.
Thank you, James. Kayvon Piristani, as James said, I look after the institutional business for APAC, based here in Singapore. I've been with Coinbase about 5 years, and I've been investing in crypto since 2013. A little bit about what we do here. So Coinbase, as everyone knows, is best known for our retail consumer experience, where we make it really easy for anyone to buy and hold crypto. Well, starting around 5 years ago when I joined Coinbase, we started to build a separate institutional business that had many of the same goals, which is to onboard institutions, particularly traditional institutions, into the world of crypto. And I'm happy to say that we've had a lot of success in that regard. Big institutions such as BlackRock, Third Point, PIMCO, Millennium, it's a very long list. We've helped enter into the crypto space to, in many cases, make their very first investments into crypto. And so that the sort of promotion of the institutional narrative is something that we're very proud of at Coinbase.
Thanks, Kayvon. Tim?
Tim McCourt with the CME Group. I've been with the CME just about 10 years, and I look after our equity, foreign exchange, and cryptocurrencies business. In terms of what CME Group does, we're a leading derivatives exchange where we offer futures and options on futures on all the major investable asset classes, including cryptocurrency. We've been in the cryptocurrency business since about 2016, where we first introduced with our partners crypto facilities, now known as CF benchmarks, the Bitcoin reference rate, which is the underlying reference rate to our futures at CME Group. And we introduced Bitcoin futures back in 2017, and since then have rolled out options products, futures products across Bitcoin and Ether, as well as about 12 other additional reference rates. And our primary offering still remains futures and options on futures, and we're a regulated US futures exchange regulated by the CFTC.
Thanks, Tim.
Thanks, Tim. Alex Hopner, CEO of BitMEX. I think I don't have to explain too much on what BitMEX is. We expanded tremendously into spot with mobile app spot trading, now FX products. We're rebuilding the company to offering all services around the globe, primarily for pro traders still, I'd say. And we have a lot in making that's still coming. It's a big heritage. Before that, I was at Börse Stuttgart, which is a small regional exchange, probably nobody knows, but was the first exchange to fully go into crypto with crypto trading in Germany. And we had the German government supporting in the crypto custody law. And with BitMEX now, as you know, and maybe one quick thing, I don't have any tickets for the rave tonight, so sorry for that one. Yes. We're here to come up with the next good products that are out there, innovative products, which we launched with the FX product, Trading 24/7, with USDT underlying, which is pretty interesting also for institutional players.
Darius?
Yeah, hi, I'm Darius. I'm the founder of QCP Capital. We are a full suite crypto trading desk, so we trade everything from spot to derivatives, especially options. We are global leaders in the crypto option space. Besides trading, we also do quite a bit of investments, including Deribit, which is the thing on your seats. But yeah, that's us in a nutshell.
Thanks, thank you. And Darius, maybe we'll start with you. I think jumping sort of straight into recent market price action, even in the context of the broader macro move, cryptocurrencies obviously being tested. Curious, and with an angle of institutional, what does this mean for institutional sort of participation, I would say, in the next sort of 12 to 24 months? And with that in mind, is this time for people to sort of take breath and work out how they're going to get involved or become active, or is it then more likely that people actually retreat?
That's an interesting question. I think if you look at the crisis that we saw, firstly, it's a global price crisis, right? Almost every asset's price is down. But for crypto specifically, it was a credit crisis. There was an implosion in credit. So I think that part of the space is definitely going to take a while to recover. But the other parts of the space are doing well. The exchanges are doing well. Settlements were fine and are still fine. The options market is very robust. And in fact, because of the high volatility and because the infrastructure was stable throughout, I think it's become a lot more interesting for institutions, right? So we have seen a big influx of institutional participation in the derivatives and options space. I was mentioning to you earlier that one single hedge fund, was responsible for about a third of the size of Ether options on Deribit in the, last month, in trading the merge narrative. So we are seeing the space shift from very, very retail-driven to very institutional and very old-school institutional, good names being in the space. So I think the space is, at least on the trading side, becoming very primed and prepped for institutional participation.
Thanks, Darius. Alex, do you care to comment?
Yeah, I think it's an ideal time. When you look for classical market participants, they always move into new technologies or new products in bear markets, because then you need to understand their governance. Nobody's expecting them to deliver, let's say, tremendous results in a month. In a bull market, everybody's complaining that you're not directly delivering double-digit good results. In a bear market, nobody expects that. So bear markets are fantastic. We've seen not a single institutional player dropping out because of the situation of the market. So we expect that a lot is happening in the institutional market next year, especially, as Darius said, from the classical financial world. Everybody's talking about it, and they will offer much more crypto products to retail investors too. B2B follows B2C. B2C is a little bit pulling back, but B2B will push in now in this bear market.
Yeah, I mean, I think from our standpoint, and maybe this is a good segue to Tim and Kayvon, from our standpoint, certainly, despite the sort of subsequent fallout and consolidation that we have seen, certainly in the provider space in 2022, we're GS is seeing a lot more on the onboarding side, a lot more flow from people looking for traditional counterparts. So Tim, sort of curious how you see this, either now or how is it you're sort of seeing this at CME and then onto the path forward?
Yeah, certainly. So I think when you look at the life cycle of institutional adoption of cryptocurrency, it's something that we've seen always in pretty strong fashion at CME. Even early days, we had a lot of our traditional market participants trading Bitcoin futures at CME. But I think there's two things to keep in mind. One is, what do we mean by institutional customer in the crypto space? And I think it means both the traditional institutions that we're familiar with, but you also have the advent of an institutional class within crypto. So think about crypto native hedge funds, some of the crypto-focused businesses that are out there. So you do have institutional flow, even if it doesn't necessarily meet the definition of a traditional buy-side asset manager or a traditional hedge fund. So we've seen continued participation amongst those various personas on the institutional front. Open interest is growing in our markets. Volume is growing in our markets. It's not necessarily just a US-based phenomenon. We're seeing it in all three regions, US, Europe, and APAC. But the second point is when we look at those firms, think banks, for example, asset managers, pension plans. These are firms that have been looking at taking those steps into crypto for years. They trust the fact that CME and others are regulated institutions. We're familiar. They know what we do and how we do it. The good news is, though, is that they've been looking at it for so long that when they first were looking at Bitcoin, it was also 18, 19, 20,000. And now here we are again a few years later. So they're a little bit price agnostic, I would say, in terms of taking that final step, because they've been much more methodical, much more prudent, and they're looking to say, how do I onward provide services in cryptocurrency to my existing customer base? They're not necessarily looking to capitalize on the price movement. It's more about how do I provide this service where things like futures become a way for them to do that. So I think that's changed a little bit. It's not just a directional bet, but it's really the provision of services from the institutional community.
Thank you, Tim. Kevin, how do you see this?
Yeah, we've also at Coinbase seen institutional interest remain quite robust despite the downturn in the markets and the reduced trading volumes. I see two reasons for that. The first is what I'll call a flight to quality trend. And this was most pronounced in the wake of the UST Terra blowup, where suddenly a lot of people woke up to the fact, sort of a rude awakening, as Darius alluded to, for the very first time, that there's really big credit risks in the world of crypto. So people started to take a really close look at the types of products they were trading, the types of counterparties and platforms they were trading on, and they came to the realization that these risks were mispriced. And one of the most interesting ways to sort of visualize that flight to quality dynamic I'm mentioning, if you look at the relative market cap of Tether versus the relative market cap of USDC shortly after the blow up of UST, you see that billions of dollars very quickly flowed out of Tether. Many of those billions of dollars flowed into USDC. So you could actually see sort of this repricing of risk and the flight to quality dynamic happening in real time, sort of before your eyes, which I thought was really interesting. But what that means for Coinbase's business is that a number of customers that maybe we hadn't talked to before, or maybe we talked to years ago and it hadn't gone anywhere, were suddenly approaching us saying, hey, Coinbase, we want to talk to you about custody. Maybe our existing provider isn't as safe as maybe we thought they were. Maybe their balance sheet isn't as strong as maybe we reckon it should be. So we started to see some new business from that perspective, which was really interesting. The other angle that I think is driving this sort of robust institutional interest despite the down market is the fact that the current price levels represent a really interesting entry point for those investors, and I think Tim, you alluded to this, those investors that have been looking at crypto for a really long time, the larger asset managers, the asset allocators, folks who have permanent capital at their disposal with very long investment horizons, but who also take a really long time to due diligence, do their homework on the different platforms, and they have a very long decision-making cycle. We've seen those folks ask us to accelerate their onboarding or accelerate their conversations to activate more quickly so they can get in at what could be generational entry points into this new asset class.
Thank you, Kevin. Maybe just to talk a little bit about volatility. I think the start of the year, volatility was a bit more suppressed on the crypto side, and really a couple of months back, really starting with the UST depegging, followed by the broader macro move, we've obviously seen this volatility pick up. Cryptocurrencies now continue to trade like risk assets. What causes that to decouple and start trading as its own uncorrelated asset class? Maybe I'll start with Darius.
Yeah, so interesting. I mean, at the start of the year, when implied volatility, option prices started to work towards the 30-40% handle, we were worried. I think we are more scared of low volatility than high volatility. So it's good that the volatility came back, but the correlation has been very high and reasonably so, because I think again crypto is or rather Bitcoin and Ether are starting to trade very similar to stocks, right? I mean, it becomes a risk-on, risk-off asset. The dislocations that we've been seeing, and this is where I think the interesting decouplings is in the vols and rates, right? So just mentioning to you earlier that last night VIX made a high of 34, while crypto vols actually gapped lower, right? Even the 14 October contract, which is a CPI contract, gapped lower as well. So you see that kind of interesting decoupling where maybe it's because there's a lot more, the crypto space is a lot more flush with USD and people are expecting prices to sideline, but you see a decorrelation in terms of the vols. Credit markets are also all over the place. So I think, while we see the headline prices correlate, and I expect that to continue for a while longer, I think you see decouplings and decorrelations in other parts of the space, especially in derivatives.
Thanks, Darius. Alex, what are your thoughts here?
Yeah, I think that a lot is, besides what Darius said, a lot is happening also when more, let's say, structurally more institutional players come into the market and provide a wider range. Then you will have this always in, let's say, not so frequently traded cryptos. And for the big ones, you'll see that this will move a little bit earlier. But for me, the really development comes with more institutional players pushing in and then offering that on a wide range and not so much sophisticated as we have it right now. And then you'll see it. But in the macro environment that we have currently, with all the stuff that goes around that, I don't see it happen too fast, actually, because there's still some anxiety around what's happening on the global scale. How much impact is that? There's still, especially on the retail side, there's a lot of, cash is king development going on. And so there is every single, let's say, signal that I get directly triggers some reaction to that one. And so there's still, as long as we are mainly driven by, let's say, human traders, this will still be a while.
Okay. Maybe we'll jump now to the recent piece of big news, obviously the Ethereum merge. This has probably set the stage somewhat for future upgrades. Maybe we'll start with Kevin. Like, how do you think that we're now going to see institutions continue to focus on Bitcoin and Ethereum, or is it more of a shift to other tokens or layer ones? How are you guys thinking about this at Coinbase?
Yeah, it's a good question. So at Coinbase, having been one of the earliest players to be onboarding clients into the world of crypto, institutional clients in particular, we've seen patterns emerge over the 5-6 years that we've been doing this in terms of what those institutional adoption trends look like. And the patterns look something like this, right? When you're talking about an institutional investor, and I'm not talking about a family office or a prop fund, but I'm talking about a money manager who's managing external capital, who's often regulated. They are extremely attuned to the reputational risks, the operational risks, the credit risk, et cetera, of even touching this asset class, let alone what particular coin it may be, right? And so, typically when they make that first journey into direct crypto investing, they pick the asset which has the least hair on it, is least risky, and so that typically means something like Bitcoin and Ethereum, right? They're liquid, they have regulatory clarity, et cetera. So they'll pick Bitcoin or Ethereum as their first sort of entry point into the space, put the trade on, put it in custody, see the reporting and the operational workflows sort of work out, and they get comfortable with holding that position over time and confident that everything is working properly. But once they cross that threshold of feeling comfortable owning some crypto, it's been really interesting to observe that they quickly move up the risk curve and the complexity curve in ways that have been surprising to me, where they'll say, right, okay, I've got Bitcoin and Ethereum. What about Solana? Can you give me some size in Solana? Or maybe I want to do some lending, or maybe I want to do some staking. And so we find that Bitcoin and Ethereum sort of ironically serve a little bit as the gateway drug into a pretty exciting world of crypto. And that's what we're seeing now, post-Ethereum merge, the same patterns repeating themselves.
Yeah, I personally got catapulted very quickly to NFTs starting with ETH. So yeah, I can relate to that. Tim, how do you see the future here?
Yeah, so I think one thing that was interesting about the merge is I think it also helped the market really understand how to use some of the tools out there. We had a lot of interesting conversations with the clients, particularly around options, where there was an element of uncertainty about what would happen at the price. Now, not necessarily was subscribing that the merge would be a catalytic price event for Ether, but there was just in the market, it was hard to ignore the fact that people disagreed on what might happen. So the fact that options give you the ability to hedge at different points on that curve, and conversely, you could use both futures and options term structure to figure out what the market was trying to tell you about price direction. So I think it was an educational element for the crypto community in that space of this is probably one of the larger events probably since we launched the futures. I mean, there's a lot of chatter when we first launched about Segwit 2x and hard forks and things like that, but I think this was a really meaningful conversation and around futures and options and Ether. The second thing I think to Kayvon's point too is I think it was immensely powerful for people to understand that there are differences between the protocols, right? As simple as that sound, but it really gave people the opportunity of what it means to go from proof of work to proof of stake, and how there are other Ethereum-like offerings out there that have other different nuanced capabilities. They scale differently. They're more transaction-friendly. So I think it was a very watershed moment in terms of people thinking about how do I use some of this in my day-to-day. So I don't know if that necessarily gets people to go beyond Bitcoin and Ether, but I think the conversations changed where it was getting much more nuanced about the differences of the various tokens and coins out there, the various technologies that are out there, and then it always circled back to, well, how do I manage the risk associated with this if I'm thinking about this from an organic kind of commercial standpoint? How do I hedge some of this if I'm thinking about putting my projects or business cases onto the blockchain? So it was very interesting from that regard, and I do think in a few years' time, we'll see more and more beyond Bitcoin and Ether, and I think we'll look back to the merge and say that was when people really started to understand some of the fundamental differences.
Thank you, Tim. I guess during this period of volatility, curious to know how it's impacted volumes on the exchanges, and then I guess to go further, what do we think the next catalyst is for more participation? So maybe Alex?
Yeah, I mean, we've seen that the market cap for certain currencies is going down and the price is going down. But when you look at volatility, we had some, let's say, sideways movements starting this year. Then it picked up a bit, and now we are up and down, up and down. But let's say trading volumes overall are not slowing down that much. It now really depends on whether we see a longer, instilled by maybe macro environment, a longer sideways development. That will be negative for the exchanges naturally. But otherwise, the volumes are still very good. And for me, coming back again to that one, B2B follows B2C. We have seen over the last couple of years a tremendous push of retail customers into the crypto space. That made the classical financial institutions greedy to get hold of these new clients. So they move into that space. They use the bear market and then open up a totally new that product universe of a standardized, for customer standardized way to address into new markets and to say, oh, existing classical financial markets. And that's then for me the next step, where already a lot of, let's say, regions are suggesting 1% to 2% cryptocurrency in their portfolio. This will increase even more over the time. And with adding, let's say, licensed derivatives, which I see is a big thing for next year, this will open up a totally new universe. When you look at the volumes of classical derivatives to classical spot, and you compare that to the crypto world, you see we're just at the beginning of the volumes that we'll see. And next year is a big year for that one. So that's, for me, the driver.
Thank you, Alex. Kayvon?
Yeah, so Coinbase has the largest pool of regulated spot liquidity in the world of crypto. So we've also observed a dramatic decrease in volumes over the preceding 9 months. And what's been interesting is that within that drop-off in volumes, we've seen that retail volumes have dropped off disproportionately compared to institutional volumes. One of the reasons for that is the fact that, if you look at these institutional adoption trends, you had way back in the day, you had family offices, prop firms, market makers, and then starting in 2020, 2021, we finally started to penetrate the hedge fund segment, particularly the macro hedge funds, and they came in and built some large positions. But then late last year and earlier this year, as the global macro picture started to turn, those hedge funds got out pretty quickly. So those hedge fund flows are pro-cyclical in the same way that retail flows tend to be pro-cyclical. They FOMO in, they FOMO out, right? And so that was sort of the story of institutional adoption of crypto up until earlier this year. But one of the cool things we're seeing in this down market, as I alluded to earlier, is larger buy and hold type institutions with much longer time horizons like asset managers, asset allocators, et cetera, coming into the space, making that first wave of initial allocations into this new asset class. And that has driven institutional volumes higher than they might otherwise be. So that's the sort of the point about the volumes. In terms of what could drive like renewed participation amongst retail or institutional, I mean, who really knows? Obviously the global macro picture needs to turn around. I think increased regulatory clarity in key markets like the US would really remove a lot of sort of overhang and uncertainty from this space. But actually the more interesting thing, and the thing that I love so much about crypto, is we don't really know what's going to drive that next wave of adoption or enthusiasm, but it's going to be some piece of innovation that comes out of nowhere that's going to surprise us, the way that DeFi did a few years ago, the way that NFTs did. And this morning, Coinbase released a blog talking about decentralized identity and the way that that could potentially pull thousands or millions of new users into crypto for use cases that are totally unrelated to speculation and trading. Right? Or maybe something else, I don't know, but that's the great thing about being in this space is you have open, permissionless innovation, and something is going to come to the fore.
Thank you, Kayvon. Maybe we'll jump now to the corporates. Obviously, we've seen a number of large corporates buying crypto, holding it on their balance sheet, or supporting crypto in some way, shape, or form. Most of the headline names, anyway, have been out of the US. Sort of curious to think here, where does Asia sit versus this? So what are some of the biggest difference in the local markets, and is Asia corporate market getting involved here? Darius?
I think on the trading side, maybe not so much corporates, but family offices, funds. I think there are less buy and hold types and more trading types, right? So they tend to participate on a very narrative-driven basis. So I think this year, when with the ETH merge, we saw a lot of interest in ETH derivatives. We saw ETH open interest for the first time flip BTC open interest. So it's very narrative-driven, right? So the next big narrative in line is probably the Bitcoin halving in 2024. So the question that we all have is, what's the next narrative in the in between from now to 2024? So I think that's something that we should all look for and look forward to. So but to answer your question, I think the Hong Kong, Singapore, the Asian space tends to be a lot less buy and hold directional and a lot more volatility driven.
Thanks, Darius. Alex?
Yeah, fully agree. When you move around, it's really the US is for them is also an asset to store, to hold, and to hodl, so to say. Europe is a bit in between, and the companies are not talking about the holdings that they have, and Asia is all about trading. Yeah, all the discussions you have is all about trading. All the family offices, whether it's arts, whether it's anything, it's all about trading. Hey, can we tokenize it? Can we trade it? How often can we trade it? And that's all the story. Maybe it's a mentality thing, but you can really see it. It's shifting when you travel around. It's shifting by this, and for here, it's just about trading. That's it.
Thanks, Alex. And Kevin, any view on that?
Yeah, I'll echo a lot of what's already been said, and I just want to maybe preface what I say in terms of, corporates I see differently than institutions. Institutions, asset managers, hedge funds, et cetera, are really, for me, the ultimate prize in what we're trying to do at Coinbase. And so when I sit down with my counterparts in the US or in Europe and we sort of compare notes about institutional client activity across these different regions, it's clear to me, and this has been the case for a long time, that the US institutional adoption is very much in the vanguard, right? And that starts with the fact that the US pool of institutional capital is simply the biggest in the world. There's so much more for them to do, right? That's combined with the fact that US institutional investors, and I'll include Canada as they call it North America, tend to be amongst the most sophisticated and innovative in the world, right? If you look at previous institutional adoption trends of other asset classes like ETFs, commodities, volatility as an asset class, US hedge funds and asset managers were really leading those pushes. And we're seeing the same thing happening in crypto today. So it's amazing to see those patterns and then some echoes of those types of behavior happening in APAC. But as Alex already said, APAC is very different. It's less about professionally managed pools of liquidity, much more about self-directed retail investing. I spent a lot of time in Tokyo, and the cliche there is the Japanese housewife Watanabe-san trading like Brazilian real leveraged FX in her spare time, which is pretty crazy if you think about it. But so APAC has less capital in terms of professionally managed money to deploy into crypto for the start. And I think also combined with the fact that APAC is not a single region, as I also remind my US colleagues all the time, it's actually more than a dozen different markets, each with their own regulatory environments and cultural postures, et cetera. And so, to the extent that, a money manager in APAC wants to do something in crypto, there's a bunch of sort of regulatory hurdles and other things that they'll need to overcome to potentially make that happen.
Thank you, Kevin. Now maybe we'll go to Tim from the institutional interest that we have seen, at least at Goldman Sachs, and where we're certainly seeing a pickup in interest is, the product moving into derivatives, options, institutional investors. Like, how do you see? They want to see a product development map. How do you sort of see that product development over time?
Yeah, I think what's interesting is when we look at cryptocurrency, unlike other traditional asset classes, the other asset classes I think developed at the wholesale level, and then it figured out how to be onward sold and packaged for retail for the masses. We're actually seeing almost the opposite happen in cryptocurrency, where it was almost a retail-driven market development, and now the wholesalers, the asset managers, the banks are now trying to figure out how to fold that into their product offering. So I see we've already seen the last few years, but I think it's going to accelerate over the next maybe 1 or 2 years, is that interrelatedness between the various liquidity pools and the various markets is only going to increase, where you're going to have more structured products. You're going to have things like forwards. You're going to have options. You're going to have the banks come in and kind of do what they've done for all the other asset classes. And we're already seeing it. There's already a strong relationship between the spot market, the futures market. We have futures-based ETFs in the US. We have other ETFs outside of the US, and they're all related. They all are moving in tandem, and market participants are funging between the various liquidity pools. So I think what it means for people like banks is we're just going to see, as they figure out how do they do that wholesale retail, marketing, how do they do that wholesale product offering to the traditional and non-traditional institutions, you're going to see this stickiness, I think, increase. I also think, going back to your other question, I think that's what helped with respect to some of the volumes and why we're seeing derivative volumes either slightly increasing or relatively flat versus last year, where that interrelatedness is here, where it wasn't there, the kind of the first crypto winter, you didn't have that non-speculative dynamic of the market, where now we have, notwithstanding the credit issues, but you have financing businesses now in cryptocurrency. You have ETFs, you have ETNs, you have OTC products developing, NDFs, you have futures underpinning some of this as the hedge at CME. So they're all related. So as a result, regardless of what's happening with the price, you're still having all this risk transfer between a lot of us on this stage. So it's really that risk transfer that is almost price agnostic, because people need to be hedged. They need to still offer their services. They're still getting inflows of money because the market, there's a buyer for every seller on every downtick, right? So they're still seeing inflows. So I think that interrelatedness is increasing, which is buttressing some of the volumes. And I think from the traditional institutional community and places like banks that service them, I think we're going to see more and more come online with very familiar looking products that just happen to track something as unique as crypto.
Thanks, Tim. Obviously, Darius, you're pretty active in this area. What's your thoughts?
Yeah, I think it's, the crypto space, the derivative space is very quickly taking the playbook of traditional markets, right? There is a whole product suite already. So anywhere from the breadth of, options on not just Bitcoin, Ether, but all the other coins, we're seeing that pick up a lot. We've also gone down the path of structures like, spreads, butterflies, vanilla structures. And we've started to see a lot of demand for exotics as well. So we started to price European digitals, American barriers, starting to see those pick up as well. Of course, it's quite a task to manage some of these things, but we've seen the interest and reasonably so as well. So I think we will quickly. There is a playbook already, so the crypto market will quickly pick up, and it will be. People are starting to see it as same instrument, different underlying, right? Mm-hmm. So and I think the most important part for this, for it to really come together, actually is the clearing, settlement, the prime layer, right? That's actually the missing piece to put all the pieces together, and for counterparties to be able to innovate and settle with each other in a more consolidated manner. But the playbook's already there.
Thanks, Darius. And maybe now, if we jump to sort of private investment, obviously continuing to see a huge amount of investment, even if potentially year on year it is lower. Do you think, maybe start with Alex, do you think we're going to see sort of a consolidation into a handful of the largest providers over the next year or 18 months? Or is it, I don't know, how do you see this playing out?
Interesting. I mean, you just have to look at the classical financial industry, and then you a little bit see what's going to happen in the next, let's say, short time and medium time. Whenever there's a new product or a new technology coming out, you see, especially when you don't have to care for legacy infrastructure, you see an absolute fragmentation of the market. So it's very easy, it's cheap to set up a new exchange or company, run your business, give it a try. And when then a bear market comes, then you see which business models are sustainable, where are really sustainable client bases built up, are not depending on too few client groups. And then there's always a consolidation. Yeah. Is it already the time that we see this boiling down to maybe 5-6 players? Probably not. Okay. Do you see, let's say, in regular time frames, correction times? Absolutely. Again, look at the classical financial industry. They are more or less every 2 to 5 years. You have something new, brings down again. Something new brings down again. I mean, we've seen that all the while. And this will happen in the crypto space too, where this was maybe this is the first real one, yeah, that we've seen. And there will be corrections, and there will be more coming. Yeah, and the more sustainable your business model, the more diverse your client group is, and the more diverse your product universe is, the better you are able to maneuver pricing points between your offerings. So you're able to maneuver which pricings or which business models are working, which are not working. You can play with these, and that gives you enough leeway then to survive these, let's say, sideways movements. Yes.
Okay, thank you, Alex. Darius, do you agree with that?
Yeah, I think in certain segments of the space, the answer is the opposite, right? There aren't enough players that are managing some of these. Let me give you an example. Let's say for options, listed options, Deribit is probably 80-90% of the listed option volume now. I think there's space for actually more players to be, they are the options order book, main order book, and the de facto clearer. There are opportunities for other exchanges and clearers to come in. The prime market is at its infancy in crypto as well. We've seen guys, K1 is doing that as well. But I think there's space for more players to come in. So certain segments actually is still, still greenfield for a lot of these things.
Thanks, Darius. Maybe we'll just jump now to regulation to cover sort of all topics. Obviously, sort of given the rapid development in this space, I guess given what we've seen actually over the past few months in terms of market moves, I'm interested to hear from a couple of you, maybe start with Kevin, how do you see regulation developing from here, particularly locally?
Yeah, very top of mind question for us at Coinbase. So Coinbase on the institutional side, we serve institutional clients across more than a dozen different markets in the region. And there's two challenges for us in doing that. Number one is to understand the regulatory posture in each and every market. And as I alluded to earlier, it varies dramatically from, China, where it's obviously somewhat crypto averse, to markets that are much more constructive like Australia, Singapore, and Hong Kong. And so we have to really have our finger on the pulse and make sure that we're serving clients in a way that's obviously always legal and compliant. But in addition to understanding the regulatory picture in all these different markets, to make it even harder, in each and every one of those markets, it's constantly changing, right? And there's been a sort of a broader trend of, handling crypto, whether it's trading, custody, or other things, becoming a licensable activity, whereas maybe previously it wasn't. Japan's a great example of that. Korea is another, and there's many others. So we have to constantly sort of monitor and make sure that we're constantly staying abreast of regulatory developments, and our legal and compliance teams stay very busy doing that. But the commitment that we at Coinbase make is by staying in front of all these developments, we can ensure that our products and our business is always compliant. We're always able to serve our customers in the best possible way. As to how the regulation is going to shape up across these different markets, I think at Coinbase we don't really want to take a stand on speculating where it's going to go. But as always, we encourage regulators to constructively protect investors whilst fostering innovation. And Coinbase also often plays a role of engaging policymakers and regulators. Most recently, for example, in Australia, where there was a consultation process around crypto custody, to really put our point of view forward in a way that I think represents the crypto industry very often in a way that's good for the industry and obviously good for the end investor.
Tim?
Yeah, I agree with what Kevin said. I think from a regulatory standpoint, one of our prime focuses at CME is that early on we made the decision we wanted to operate as a regulated venue offering regulated products. And that certainly is something that's resonated strongly with the institutional community, because they need that guarantee or that confidence of how to take those final steps into the industry. And they prefer, and some are required to have that regulatory framework in place for products that they're trading, holding on their balance sheet, et cetera. I think the challenge, though, is that somehow over the last few years, it's seen that regulatory oversight could be a bad thing. And I think actually that the opposite holds true, where if we did get further clarity in more jurisdictions, it would further increase the speed of innovation, because there would be certainty, there would be finality about some of these topics that are overhanging the industry. So I'm not going to pretend necessarily to be an expert on local regulatory matters. I certainly have my hands full dealing with it back in the States. But I think generally speaking, the regulatory process must balance giving the marketplace that confidence and that certainty with allowing innovation to still happen. And the pendulum can't swing too far one way or another. So I think just that balanced approach of how do you move quickly on the regulatory front, how do you let some of the innovation still happen naturally, but giving the institutional community and the community more broadly the confidence and trust they need in the system, balancing all those things is critically important. And I think it's gone well in the US. I think we've done well as a regulated venue, but it's still certain. We still have our own challenges and looking for further certainty from the regulators. So hopefully we'll get it in the next few months.
Awesome. And then and this one's open to any one of you. I guess anything we haven't mentioned today that may or may not be on people's radars that could be the key catalyst for the development of institutional markets. Is there anything we haven't covered?
Yeah, I want to build on something that Darius said. I think especially on derivatives, and they are for me the biggest products and the biggest nut to crack on the classical side, we are just at the beginning. Yeah. at the small regional exchange I was responsible for, we had 1.7 million structured derivatives. And we have what? Nothing in comparison to that. We were trading 5,600 regular on a daily basis in a high volume. Yeah? So this potential, and that was all retail investors, this potential we gradually tapped into. And I think that, as Kevin and Jim said, the regulators that are regulating function in our technology, they're technology agnostic. And the next big thing is derivatives licensing and regulation. And we will see a big step in that direction. You see the US is moving, MiCA regime is coming. So there's more and more coming, and spot, brokerage, custody is already relatively regulated. The next big thing is derivatives. Where that falls, the whole bucket of volume is all of a sudden available over the crypto space with the efficiency of not having to care for post-trade. That's it.
Thank you, Alex. Unfortunately, out of time. Really enjoyed the last 40 minutes. Thank you, Kevin, Tim, Alex, Darius. Thank you, guys. Have an awesome day.